Welcome aboard the Pilot Money Guys podcast, where our mission is to help professional pilots build and protect wealth on their journey to financial freedom. This podcast is brought to you by Leading Edge Financial Planning.
Hello, Kevin again, Professor Gormley. Here we go. Flight 113 today. Can you believe that? 113 episodes of the Pilot Money Guys. And so we're still cranking, Kevin. As long as there's good topics to cover, we'll do it.
Yeah, super exciting, Charlie. Glad to be here. If you all have other topics you want us to cover, please let us know.
That's right. Absolutely. Yeah, there's a bunch of good ones out there. And today we're going to talk about private equity. So recently, Kevin, there's been an executive order signed that says the DOL, and I'll try to use the right wording, should strongly consider or figure out a way to include private equity into your 401k. So we're going to talk about that a little bit into the 401k. We'll talk about private equity in general, pros, cons, maybe some misunderstandings here and there, and just provide some good information today for our professional pilot tribe so they can make good decisions for their own finance. So, Kevin, without further ado, let's talk about the Pilot Wealth Index. The most important thing, go check out the Pilot Wealth Index. Yeah. I know I've built
Speaking of private equity, check the Wealth Index.
Yeah. Check out our private equity Pilot Wealth Index. Just take that in all seriousness. The link is on there. Check it out. You can get a feel for, hey, am I thinking about the right things? It's not a foolproof way to know if you're on track for retirement, but I'm thinking about the right things. And so check it out. Let us know if you have any questions, comments. We're here to help and give us a rating and review on the podcast. That really helps us to reach more pilots and just try to help educate and provide good, objective information for our pilot community. But Kevin, what do you think? Private equity, good, bad, ugly, indifferent? What are your initial thoughts?
Yeah, I'd say all of the above, Charlie, but really, private equity is interesting to me because for years I thought maybe I was missing the boat on something, and I deep dove, I guess is the word, into it and tried to figure out why it was so great. And I understand some of the premises around private equity. I think, it's something that I think we should all be educated on. But, with the president's signing of whatever it's called, executive order, you said, it really puts it in everyone's face now. You're going to see it. Maybe people will be advertised to. We don't know to what extent, hey, maybe you could buy all private equity in your 401k. Hopefully that's not going to be the case. But, so lots of mixed emotion around this, Charlie, is really what I'm trying to say.
Yeah, and absolutely. That's why we're attacking it. We've probably talked about it before. I don't know that we've spent the whole entire podcast on it. But you and I have known about private equity. We've invested in some of it before. And so we have some experience that way. But yeah, the big change here is the executive order allowing it into 401ks. So first of all, before we go on, what is private equity is a great place to start.
Yeah, so I think if you want to talk about private, first you should talk about public, Charlie, because the public markets is something that we all know. And I think, everybody that's listening to this podcast knows that certain days of the week, certain hours of the day, the markets are open for trading. And there's people all around the world buying and selling equities, buying and selling pork bellies, buying and selling anything. And that's a public market. You come to the market, you don't need to know the other people. You don't need to sign contracts with them. You just, whatever you want to invest in is there. It's available. You buy it and you own it, or you sell it and you don't own it. So it's pretty easy to understand about public markets. And to us, Charlie, the really exciting thing about public markets is that they're constantly being priced. Yes. Every time you buy something, every time you sell something, you're giving up or buying that investment for a certain price. You're setting the price, in other words.
Yeah, absolutely. And a lot of times we don't like the word regulation. Sometimes regulation has bad connotations. But in this case, since 1929, with the creation of the Securities and Exchange Commission, the whole objective there was to allow the public to have more transparency on these publicly traded companies. And like you mentioned, not just more transparency about the company, but about the pricing. Today, we get pricing minute by minute, whereas that may not be available in the private equity space. It is not available in the private equity space. We'll talk about that more, but let me give maybe a little more textbook definition to help us too. But it says, private equity refers to investments typically made by private equity firms, okay, no duh, venture capitalists, or angel investors. So we've all heard about some of those. Unlike traditional stocks or bonds, Private equity investments are not traded on public markets, like you just noted, making them less liquid, but potentially offering higher returns to compensate for the added risk and longer investment horizons. There's a couple really big nuggets in there, Kevin. We're going to talk about illiquidity. They talked about less liquid. We'll call that illiquidity, if that's the right word anyway. And then longer investment time horizons. That's a big deal too, because there's a lot of risk there. So we'll talk about more of those. That's kind of to set the stage anyway on the private equity definition. So what's the big deal? Again, why can't we do this already in the 401k? Now, we'll talk a little bit right now, Kevin, about accredited investor. Yep, you can do it right now if you're an accredited investor, whatever the heck that is.
Not in your 401k, though.
Correct, not in your 401k. We'll define that. But right now, if you're an accredited investor, you can go buy oil and gas, limited partnerships, general partnerships, and those are private equity. But now we're talking about this more because it possibly may be coming to the 401k, like I said before. But why can't we do that already, Kevin? Any thoughts on that? Why can't we put private equity in our 401k right now? What the heck?
Yeah, so the reason is that when you do buy an investment with private equity, you end up signing a bunch of contracts. You must be an accredited investor, just like you said. Usually that just means you have to have a lot of money. They always make us feel good that we're sophisticated investors. Yeah. You must be a sophisticated, accredited investor. All it really means is you have a lot of money. And you can afford to lose it, but you really have to sign up with that company and you make an agreement with them, and they might pay you over a certain amount of time, and nothing's guaranteed. There's 79,000 pages in the prospectus, but for a 401k, it's not something that you can just drop your $1,000 a month in, because you have to sign paperwork each time. So it's just not something that's fit into a 401k before.
Yeah. And by the way, accredited investor is $1 million net worth, not including your home, or you've made $200,000 the last few years. I can't remember if it's 2 or more, but nonetheless, most of our audience are accredited investors, so they can pat themselves on the back for that and feel wonderful. But like you nailed it, isn't, sometimes people use that as a sales technique. Hey, you're accredited, you're special. But really the SEC is just saying, hey, look, we don't give a crap if you lose your money, because you got enough. And so that might be a better way to say it. So, the SEC was created, after the Great Depression in 1929, and then the Department of Labor came on board some point after. But nonetheless, the entire objective, in fact, of the Department of Labor and SEC is to protect, protect investors and consumers. But let me get a little more specific. The 401k is meant to be a place where it's, I'll say, relatively conservative, and I'll talk to that because the government has a vested interest in all of the citizens gambling away their 401ks. That would be bad for the entire economy, bad for the entire country. So they've been very cautious, they as in Department of Labor, about how 401ks are regulated. It's a highly, highly regulated space. And so those are some of the reasons and some of the context, if that helps a little bit anyway.
Yeah, Charlie, and let me just go through kind of the different ways that an investor could invest. Number one is they can invest by themselves. They can start a business. That's investing in your own business. Number two, you could form a partnership, invest with a bunch of people. Then greater than that would be something like a private equity, where you're basically handing your money over to other people and you're having them invest the money for you. Mm-hmm. Now, when you're involved in the business, you probably know what's going on with the books. As you get farther and farther away from the day-to-day business, you really don't know what's going on with the books. So the other part about private investment that these companies like is that they can charge more fees than they would in, let's say, an ETF, exchange traded fund. And so a lot of the financial world has been very attracted to private investment because, Vanguard is loved and hated. It's probably hated more by investment companies because they brought prices down close to zero to be able to invest. And private equity and private real estate, those are some areas that, there still are a lot of fees to be had. So there is absolutely a motivation for you to hear about private investment, because that's where the money is, as they say. As Willie Sutton? Willie Sutton said that, when they asked him why he robs banks, he said, because that's where the money is.
Oh yeah, there we go. That's more familiar. I got it.
Yeah. So that's the reason why you're hearing about this, is because that's where a lot of the money is right now, Charlie.
Yeah, excellent. So we don't want to bash the private equity world too much. It's a specific way of investing. And so we just need to understand how that's, is it appropriate for us? How's it going to be wrapped in the 401k? And so we've seen this, Kevin. I'll start with some of our experiences. Excuse me. We've seen this in some private real estate type investments. That's probably that. I think in oil and gas to me are some of the most common that are available to our clients. And some of our clients have done those. And we've learned about those in the past as well. And so for me, Kevin, the upshot here is that you can do really well with a private investment, oil and gas, real estate, whatever it may be. Or guess what? You could lose all of your investment. So that sounds familiar, right? Like any other investment, you could do really well, but there are risks, and you could also not do very well. So, I mean, it's kind of not a whole lot of different in that area anyway, as far as the risk is concerned.
Yeah, just so our client base doesn't think we're unaware, a lot of the private equity, Charlie, is about running other companies, about running a certain style of business. It's about leveraged buyouts and improving companies and then selling them. Even private debt now is a huge part of private equity. So it's not just about real estate and oil and gas. There's whole different ways or many different ways that a person could invest in private investments. Really, the most important thing I think to know is that there is only one Earth and one universe, at least as far as I'm concerned, Charlie. I'm not going to get into if the Earth is flat or round, but there is only one place to invest. And a lot of times private equity people act like they're investing in a different set of circumstances. Like there's just better things to be had in private equity because the really smart people are there and they're able to determine this, that, and the other. And I think there's one investment universe. And if things are really good to invest in, don't you think the publicly traded companies are going to go after that as well?
Yeah, absolutely. You're right. It's certainly no different. The economics are the same. And there's also this behavioral component of private equity where, hey, I get to do what the rich people, quote unquote, do. So it kind of becomes this attractive thing to get into. But, the people I've seen do it, I don't want to even say successfully, but do it the right way. They've done their homework. They've really read the fine print because you have to now. The transparency is not, as regulated as it is in the public markets. And they understand what they're getting into. The risk is appropriate for them and their specific situation. But I do believe there is this aura out there of, hey, I'm an accredited investor. They've got $100,000 minimum. This is what the really wealthy people do, so therefore we should do it too. I think that's the wrong mentality. The right mentality is do your homework, understand what it is, understand what the risks are, and in your personal circumstances. It may not be, one circumstance I think of is a person has zero debt, very solid balance sheet. They're maxing out all of their traditional accounts, and they have extra money, and they're like, hey, there's an opportunity here. We've researched it. It's oil and gas, and we're going to do it. And so to me, that's the kind of mindset that I would have with these kinds of things.
Yeah. And Charlie, I'll just say that, private equity, they do have to have a lot of disclosure. Mm-hmm. They do have to put a lot of data forward. I think the real difference is that the public markets are a way for us to know what's going on. If something bad happens to a company, if NVIDIA reports really terrible earnings, they didn't, but if they did, the market would let you know immediately what's the belief, the collective wisdom around what that company is doing. Where private investment, they'll send you a quarterly statement, but how much of it can you trust? What valuation methods did they use? You need to know valuation methods if you're going to be a private equity investor, Charlie.
Yeah, that sounds fun. Not really. But Kevin, let's talk about volatility laundering.
Yeah.
Favorite topic to talk about. And it's going to lead us in to talk about the illiquidity premium that we talked about and then time horizon. So one of the major differences as far as we get into nuts and bolts is the pricing, the reporting. With private equity, they don't have those same requirements, so it can appear a little different. But any thoughts to add on that as far as the volatility smoothing or laundering or whatever.
Yeah, so when you look at risk, and I'm not a CFA, Charlie, so I might say things a little bit incorrect here. Please have some kindness with that. But when you look at risk, they use metrics of volatility as a big metrics in a lot of risk. So if an investment goes down a lot and goes up a lot, that would be a more risky investment. So a lot of times with private equity, they'll say it's not as risky as public markets because it doesn't go down as much as public markets will go down. And so what ends up happening is, in 2008 was a prime example of this. Markets crashed, and there were a number of privately traded REITs and other private products that did not crash. They actually held the price. And for months, people said, oh, look at that. They haven't lost any money. These people are geniuses. So they just have different requirements about when they have to value whatever their assets are, whatever they have to value their cash flows. Of course, the rest of the story in 2008 and 2009 was a lot of people looked at their investments, and they saw everything was down. And then they saw, hey, my private equity is not down. So what am I going to do? I'm going to go get money out of that. And then so everybody wanted their money at the same time out of private equity. And then they were not able to get their money because they had to shut it off. And then eventually, the books came out and they lowered the value of the investment inside those private products. And eventually people realized that although in January of 2009, their investment wasn't down, it was down a lot in May of 2009.
Yeah, absolutely. And you hit on, the pricing, reporting requirements and the liquidity, which we'll talk to in a second. But Cliff Asness, who we respect a lot, is a very smart dude on these and has written a lot. And he says private equity holdings are typically valued only quarterly. And these valuations often rely on models and assumptions rather than real-time market pricing. And Kevin, that's what makes the market so efficient, is they're priced literally by the second, based on the buying and selling. But he goes on to say, this infrequent valuation schedule creates an artificial smoothing effect. And that's where he's talking about smoothing out this volatility, like you just referenced there as well, and making returns appear less volatile than they actually are. That's not the only place that happens. If we own real estate, if I'm own real estate in my little town here of Maryville, Tennessee, I'm not going to see that value fluctuating wildly. And in some ways, Kevin, that helps me. In some ways,
Absolutely.
that kind of helps me stay with it a little bit, I would assume anyway. So there's some things there to think about.
Yeah, well, no, I do think the non-valuing of every day can be a benefit. Like we always say, if you drove out of your garage and someone every day yelled the price of your house to you, and during times of dark days, and they start yelling you a really low price, that might be kind of upsetting. And you don't get that, and you don't get that with private equity either. So you look at your account, 89 days out of the 3-month time period, it looks good. And then the one day that it comes out, it still looks okay. And, so then it brings some peace of mind to people, Charlie. And that is one of the benefits in the private REIT market, by the way. That is what it was, and that's how they sold it. And then all of a sudden, the SEC changed the rules and said, no, you have to value it more often, especially when there's a significant downturn in markets. And so what was a benefit all of a sudden became a curse, as a lot of people found out their investments that they thought were worth more are actually worth less.
Yeah, absolutely. And so that volatility is real. It's really there. And so that's hard sometimes. And that's why they've been excluded from 401ks, because it's challenging. There are other examples where we've seen investments that we thought were pretty good investments inside 401ks removed by the administrators because they were too volatile. And let me just make that into real life here, translate it into real life. What that means is, Kevin, if you and I see an investment go down, and we're average investors, and we go, man, that investment therefore is terrible. It's going down. It's been down, and therefore it's terrible. And therefore, what's my next move going to be? I'm going to sell it. I'm going to sell it because it's down. And then I look at another investment. I go, man, that thing's been up for a couple of years. I'm going to buy that one. So that is a cycle that repeats over and over again. It's called selling low and buying high. And so administrators in 401ks know that, they see that, and they will remove those investments to prevent bad investment behavior. So that's something to watch out for. we don't know how these are going to manifest. Again, the private equities inside of 401ks, they might be inside a target date, they might be inside of another wrapper, but those are things that we'll have to watch out for as investors. Is just that the behavioral component can be pretty challenging. But on top of that, can you talk to the illiquidity part of this? And this, I think earlier we talked about this liquidity premium, but what does that look like in this world of private equity?
Yeah, so incentives are really important, Charlie. We talk a lot about incentives. We're fee-only financial planners, investment people, and if markets go down, we actually will get paid less. And that's just a part of our business. We recently talked about 2022, 2020, other years when markets crashed. Our business, didn't do as well because our clients lost money. So that our incentives are aligned, at least in the fact that we're getting paid less if investments go down. With private equity company, if they can keep their valuation high because they're also getting paid on a percentage of assets under management, they actually will get paid more. So instead of the markets being the arbiter of what the investments are valued at, the leadership team, is the one who's going to hire the valuation people. They're going to be giving them the information. They're going to want to keep values high. So, and that's one of the reasons why, Warren Buffett doesn't like private equity, is that he thinks incentives are misaligned. They want to keep it up as high as they can, even when things are bad. And then when they sell it, they want to sell it for as much as possible, which is good. That's a good part. When someone is buying it, that's typically it's being valued at that point, Charlie.
Yep. Yeah, absolutely. And some of the things we talk about as far as your circumstances, time horizon. What is my time horizon with the high volatility? Like a lot of these, I think endowments and pensions have had private equity before. It doesn't mean they're great, by the way, but their time horizon is very different than your time horizon, Kevin, or my time horizon. And so that changes how we might invest as well. So that's, again, another consideration in some of these private equity investments.
Yeah. So, hopefully we'll get the comment. Maybe it'll be on our YouTube channel that, you guys know David Swensen. David Swensen is pretty famous for the Yale endowment and how well he did. And he used a lot of private investment. And for endowments, when you're going to need the money, a little bit at a time and then sometime in the future, then private investment is just fine. Illiquidity is just fine. You don't have, grandpa, grandma, or let's not just use old people, mom and dad, or even the children all of a sudden panicking and saying, I want all my money back. That's not what happens in an endowment or in another type of a trust like that, Charlie, where people, they do have a long period of time. So what's interesting to me about a private equity is, on the one hand, they say what the returns are going to be and you can make money, really a lot of money. But on the other hand, they say, look, you need to stay invested a long period of time. And both those things, I think, are true. I think you can make a tremendous amount of money in private equity because you're forced to stay the course.
Yeah.
But I don't even know where I'm going with that, Charlie. Sorry.
You're right. I mean, it's interesting, though, how this will translate in the 401k and how they'll wrap it up. But it seems like they will have either a fund of funds inside the 401k, or again, inside the target date where you won't even see it. But you made a good point earlier too, like, hey, what if I take private equity, put it in a mutual fund and put it in a 401k? Now what is it?
Yeah, probably, what is it?
Yeah, probably acts like a regular mutual fund.
That's like, Charlie, taking an Airbus and sending it to Boeing and saying, fix it up a little bit. And then you send it out on the line and nobody knows what the heck it is. That's what is happening right now. Yeah. All right. Maybe that's a terrible analogy, Charlie. You're not smiling. So maybe that's a terrible analogy. But you have a private product, which means it can't be traded. You get to price it. And then you put it into a publicly traded vehicle that now gets to be traded and it gets priced every day.
Yeah.
So is it more like the publicly traded investment that will go up and down as markets go up and down, or is it truly a private investment that will be priced every once a quarter or whatever the agreed upon amount of valuation is? Yeah. And then, what are the returns going to be like? I don't think anyone really knows that. And that's what a lot of people have written, that they just don't know. What's going to happen to a really small private equity company when everyone in the publicly traded fund is selling it?
Yeah.
What's going to happen when they have to sell all of their assets?
Yeah. And the opposite can be true too. When everybody's buying this and it gets inserted into a 401k, everybody's buying it. The prices have been bid up because everybody's buying it because maybe they have to. It's in a target date. And then possibly that future expected return is not as high as it once was because now the valuations are higher because it's more a popular buy. So there's some things there that'll be interesting to see how
And who decides, Charlie? Who decides which private companies are going to be the ones that get in the 401ks? How does that work?
Yeah. A lot of work to do on the 401k administrators. It should be pretty interesting how they do this, and the Department of Labor, and we'll see how it plays out there. But Kevin, what do you think? Any other nuggets there? Any other nuts and bolts that we didn't cover?
Yeah, my biggest nugget, Charlie, is at the end of the day, it probably doesn't matter.
Yeah.
After all we've said, it probably doesn't matter because you're probably only going to put a couple, 3%, 5% of your money. It's going to go into private equity if you use a target date fund. And it's really not a lot of money.
Yeah.
So it probably won't make any difference to your overall returns. You're going to be able to tell people, yeah, I'm in private equity, but they'll say, yeah, me too. Everyone will now be in private equity, Charlie. So
that's right.
It might not be quite as sexy as it used to be. I don't know. What do you think?
Yeah, that's a great point. And so, yeah, it will probably be almost transparent inside that 401k, whether you own it or not. And they're going to make it very controlled. And that's probably a good thing for the overall, if, again, like we described earlier, if private equity is right for you, you're an accredited investor, you've got the solid balance sheet and the money to be able to go out and take some extra risk, but then there's other markets to be able to do that as well. So, but if anybody has any questions, Kevin, we'd love to hear about them. Comment on the YouTube channel, send us an email or a message any way you can via social media, but you can reach us at kevin@leadingedgeplanning.com, charlie@leadingedgeplanning.com, and we'll find an answer for you.
You work for private equity, call Charlie, email Charlie.
Yeah, we'll have you on the podcast as well, and we want to cover all of our bases. So absolutely. But interesting topic, interesting development, and we'll see how it happens, see how it plays out. All right, Kevin. Thanks again for joining us today, Kevin, and we'll see you next time. Hello, Pilot Podcast family. Charlie here. I just wanted to share with you something we've just recently developed. In the show notes, you're going to see the Pilot Wealth Index. We want you to check it out, give it a shot. It's a quiz, a short questionnaire that allows you to understand, are you on track? We have a lot of people that say, hey, we just want to know if we're on track. Are we where we should be at this stage of our flying career, airline career, whatever it might be? How am I doing? Am I close to my peer group? Am I behind? Am I ahead? We've developed some questions, some metrics that we think if you go through this and check it out, answer the questions, you will have a very good idea of where you stand. We developed the questions that give an indication of, are you doing the right things you need to do to be prepared for an eventual retirement, and that one that can be profitable for you. So check it out in the show notes, the Leading Edge Pilot Wealth Index. We hope you give it a shot. If you have any questions at all, reach out. Happy to help. Charlie@leadingedgeplanning.com. Again, that's Charlie@leadingedgeplanning.com. You can call or text me on my cell, 865-328-4969. Thank you very much.
Thank you for listening to the Pilot Money Guys podcast. Please subscribe, rate, and review on iTunes or wherever you listen. We are grateful for your reviews because they encourage others to listen in. Visit leadingedgeplanning.com to learn more and subscribe to our newsletter. Leading Edge Financial Planning, LLC, LEFP, is a registered investment advisor. Advisory services are only offered to clients or prospective clients where LEFP and its representatives are properly licensed or exempt from licensure. For additional information, please visit our website at www.leadingedgeplanning.com. The information provided is for educational and informational purposes only and does not constitute investment advice, and it should not be relied on as such. It should not be considered a solicitation to buy or an offer to sell a security. It does not take into account any investor's particular investment objectives, strategies, tax status, or investment horizon. You should consult your attorney or tax advisor. The views expressed in this commentary are subject to change based on market and other conditions. These documents may contain certain statements that may be deemed forward-looking statements. Please note that any such statements are not guarantees of any future performance, and actual results or developments may differ materially from those projected. Any projections, market outlooks, or estimates are based upon certain assumptions and should not be construed as indicative of actual events that will occur. All information has been obtained from sources believed to be reliable, but its accuracy is not guaranteed. There is no representation or warranty as to the current accuracy, reliability, or completeness of, nor liability for, decisions based on such information, and it should not be relied on as such.